Assalamu alaikum, dear students. Hope you are well. I expect that all of you are in safe and all of you keep up your study well. Okay, I am Muhammad Samad Khan, lecturer, Department of Accounting, Dhaka College, Dhaka. I'm I'm going to take a new class on the theory of capital structure. It is the new class. Today the topic is the theory of capital structure under NI approach or NOI approach. I mean NI approach means that net income approach, and NOI approach means that net operating income approach. Okay, dear students, let's start our class. Let's see what is seen in the whiteboard. Company or corporation usually uses a single source or a number of sources of capital as like debt and equity mostly. Here we see that company or corporation usually uses a single source. Uh, a corporation may use a single source. Common shares or number of sources of capital as like debt and equity. Okay, sometimes we use preferred stock in a corporation or a company. Okay, here study of capital structure seeks the relevance on equity and debt. Study of capital structure seeks the relevance on equity and debt. Operating leverage is different from financial leverage. We study the benefit of fixed cost in case of expanded production. Here is benefit. Dear students, you already know that what is the leverage or what is the financial leverage. Okay, when we use the fixed charge of capital, it is called financial leverage. Debt. Okay, so it is called financial leverage. So financial leverage is different from operating leverage. Operating leverage is used, which is study the benefit of fixed cost in case of expanded production. Okay, dear students, here importance of capital structure. What is the why important capital structure in a corporation or a company? Okay, because a company or corporation, in a company or in a corporation, capital structure is important for so many reasons to achieve a goal in the firm. Is like, one is it gives an ideal debt equity ratio. It gives an ideal debt equity ratio. Why? Because we know that how much debt is used in a corporation. If the ratio is 2 or 20, say minimum, a corporation may use 80 lakh taka debt or 20 lakh taka stock or shares or common shares. So it is important to discuss or to analyze the elements, that how we can use the ratio in the corporation or in the in a company. Okay, so it is important to a corporation, debt and equity ratio, analyzes the debt and equity ratio. Okay, then it gives up high risk financial resources. Okay, sometimes whenever we have many sources of capital, so many resources in a corporation, but there is a lot of resources or sources of capital which are risky. So the risky financial resources are then are aware to me or to the corporation by the capital structure. Okay, it gets tax advantages. It gets tax advantages. Okay, four, it maximizes the wealth of shareholders. Okay, so when we finance in a cheap sources, I mean which sources are cheap or which sources expenditure are cheap, of those sources should use and maximize the wealth of shareholders. If we use the debt or financial leverage, then we may decrease the weighted average cost of capital and increase the value of the firm. Okay, so in this question or in this chapter, we may analyze this question, these papers, so that we may say that if we use or if we increase the use of leverage, then we may increase the value of the firm and decrease the weighted average cost of capital. But it is the true for this reason. Okay, we will see in next NI approach what will be happened in NI approach. Okay, we know that, dear students, we know that David Durand identifies two extreme views. One of is NI approach and second one is NOI approach. So we are discussing the NI approach and second one is NOI approach. So today we are discussing the NI approach. What is said in the NI approach? Okay, so net income approach. Here it is said that use of debt is favorable or capital structure is relevant. Whenever we are use use of debt or financial leverage is favorable or capital structure is relevant, then on the time it reduces cost of capital and increases the value of the firm. Okay, again I said that when we use of debt or financial leverage and on that time the financial leverage is favorable, not unfavorable. In the NOI approach it is maybe unfavorable or it is unfavorable, but and in the NI approach use of debt is favorable or capital structure is relevant, not irrelevant, it is relevant. Then on the time it reduces or capital structure reduces cost of capital and increases the value of the firm. Okay, so cost of debt here NI approach, in the NI approach cost of debt and cost of equity are independent or constant. So weighted average cost of capital declines. I mean weighted average cost of capital declines, I mean decreasing, and the value of the firm rises with increased use of leverage. I mean when the leverage is, say the leverage is 10 lakh, on the time weighted average is say suppose that weighted average is 10%, then when we increase the leverage, I mean 10 to 12 lakh or 15 lakh, then weighted average cost of capital decreases. Okay, so we already seen on the previous chapter, I mean contribution of the financial leverage and capital structure, we already learned on on that chapter. Okay, so I want to say that in the NI approach, uh, cost of debt and cost of equity totally constant or independent, and weighted average cost of capital declines and increases the value of the firm. Okay, when increasing the uses of leverage. Okay, here NOI approach, I mean net operating income approach. What is said under NOI approach, net operating income approach? Leverage is assumed irrelevant. It is not relevant. So here the cost of debt and the cost of equity is assumed to increase linearly with leverage. I mean, here NOI approach said that the cost of equity and the cost of debt will be increased on the time when leverage is increased. Okay, if leverage is increasing on the time, cost of debt and cost of equity will be increased on the same time. Okay, so as a result, weighted average cost of capital remains constant, it is independent, and the total value of the firm also constant. Okay, there is no change. Although leverage is going on or leverage is increased, but leverage is increased and cost of debt and cost of equity already increased, although increased, and on the time the total value of the firm also constant, because weighted average cost of capital also constant as leverage is changed. When the leverage is changed, I mean net operating income approach on NOI approach said that the cost of debt and cost of equity, if the cost of debt and cost of equity increased on that time, leverage will be increased, but the value of the firm constant, and weighted average cost of capital also constant. Okay, so assumption of the capital structure. If we understand or if we realize the capital structure theory of the capital structure, so we should learn this assumption of the capital structure. Assumption of the capital structure. What is said in the assumptions? Okay, we see that one is firms employ only two sources of capital, debt and equity, I mean common share. Okay, so here only two sources of capital are here. One is debt and second one is capital. 2. The total asset of the firm are given. The degree of leverage can be changed by the selling debt to purchase shares or selling shares to retire debt. Okay, dear students, already we learned that, we realized that what is said in the two section. 3 number, the firm has policy of paying 100% dividend. Here it is said that 100%, just how much dividend is declared, total dividend is paid out. Okay, the firm has policy of paying 100% dividend. 4 number, net operating income of the firm are not expected to grow. It is not expected. 5. The business risk is assumed to be constant. Here the business risk is constant. Is to be constant and independent. Okay, constant. 6. The corporate taxes doesn't exist. Corporate taxes doesn't exist, although later on the corporate taxes doesn't exist. Later on, it is relaxed. Okay, please. 7. Investors have the same subjective probability distribution of expected future NY net operating income for given a firm. Okay, dear students, all of 7 are the assumptions of the capital structure, theory of capital structure. Okay, I mean here in the analysis of capital structure theories, we should follow, or we should think the definitions or basic definition would be used. We see that which are used in the capital structure, capital theory of structure. Okay. Dear students, the terms which are used in the capital structure is as below, as like S equal market value of the shares or stock, market value of the shares. D, market value of debt. Okay, S, D, E, earnings per year, earnings per year. V, total value of the firm. So B equal S plus D. I mean value equal S plus D. I mean market value of shares and market value of debt. When we sum to this is equal V. I mean value of the firm. Okay. So here we also used NOI. I mean NOI. I mean net operating income. Net operating income. It is called X bar. NOI equal X bar operating income. It is like that EBIT. It is like that EBIT. We say that EBIT equal NOI or X bar. Okay. So EBIT I mean earning before interest and tax. Okay. Please, dear student, then we use R. R equal total interest. Total. Okay. R equal total interest, or it is said return on debenture, or it is interest charges. Okay. So here NI, net income. Net income is called NOI or X bar minus R equal NI, net income. Net income, net operating income, or X bar minus R. I mean interest charges or return on debenture or total interest equal NI. Okay. So here cost of debt KD equal R by D. It is the cost of debt. Okay. It is cost of debt. KD equal R by D. If value of debt, I mean D, value of debt, D equal, what is? Say R equal KD into D. So D equal R by KD. Okay? So D equal R by KD. Okay? D equal R by KD. Cost of equity. Cost of equity KE equal D by P plus G. D by P plus G. Okay. So here D equal dividend, P equal initial price, and G equal growth rate. It is also called in another way E by P, E by P. So E equal earning. E is earning per share. Okay, here G equals 0, so 0, so E by P. Okay, so cost of equity equal E by P, or cost of equity equal NI net income, NI by S. Cost of equity equal NI by S. Previous NI net income divided S. So net income as S means value of the equity, or value of the shares. Okay, S total value of the shares, the total value of the equity. So we already learned KD and KE. Here the cost of capital, overall cost of capital KO equal NOI by V. NOI by V. I mean NOI, we already learned NOI, net operating income, and V, value of the firm. Okay, so overall cost of capital equal NOI by V, or in another way we already know that KO equal KD into D by V plus KE into E by V. Okay, we already learned that KD into D by V plus KE into E by V. Okay, earning E by V. Okay, so we already learned this V equal S plus D. V equal S plus D. Okay, so it is said in another way that X bar divided KO V. I mean net operating income divided overall cost of capital equal V. Okay, so I think that you already learned that what the basic needs, what the basic elements of this chapter will be used. Okay, good. So I think all of the equations and definitions described above are true of any capital structure theories. I expect that all of you already learned this and realize this. I hope that it will be used later. I mean, it will be the definitions or equations will be used in the next classes. I think all of you will learn this and we will use in the next class. Okay, thank you.